Good morning, ladies and gentlemen.
It is indeed very difficult to be talking about a fundamental subject in a technical conference. When Sushil suggested to me to talk about deflation, I was surprised. He didn't ask me to talk about technicals. Possibly he didn't have confidence in my technical. Anyway, I think deflation was a buzzword in March when the entire topic was finalized. And I was wondering whether the buzzword could last till May. Yes, it has lasted. So some of the basic assumptions with which we have lived through the 20th century are being threatened in the second decade of 21st century. It's a bit difficult to digest, but of course, as we go along, we'll understand what exactly we are going to grapple with. So, first of all, why all of us are here? Please. Huh? Then, to learn technicals, okay, fair enough. Then, pardon? Make your networking. Why? Yeah, just we'll expand this as we go along. What is your objective? Tell me, forget about networking, learning. What is your objective? Yeah. What is that you are going to do with that? Tell me. Yes? What is that you are going to do with the money that you are going to earn? Pardon? Happiness. Enjoy. Better life. Anything else? Pardon? Okay. Then? Oh. Let us not talk about some unviable proposition. So basically, this gentleman told about happiness, and then somebody told to make more money. And then what else you do with that money? Think. It is not an art of living class. Spend on luxuries, madam is saying. Okay. See, basically, this sums up the psychology of 20th century. Possibly. What is that? There is money in one hand. There is goods on other hand. If I call the happiness, luxuries as goods, and then money is one hand. You are, see, basically a human being arbitrages on a daily basis, hourly basis, minute by minute basis. You are here paying, let us say, X amount of money for this conference. What is the arbitrage that you are trying to do? Paying X amount of money, you want to gain X plus one amount of money doing your trading. So in our entire life, if you see, we have always been arbitrages. We arbitrage between money and goods. So basically, there are two things in the world. One is money on one hand and goods on another hand. If I call that happiness, luxury, and all these things put together, I'll have it as left hand, it is goods. So basically, at every point of time, we try to arbitrage between money and goods. Let us say, we have all been used to, basically the demand and supply of money is always there, demand and supply of goods is always there. If I say, the money is going, whatever the money that you are having now, what is the cost of that money tomorrow? What is the price of that money tomorrow? Lower or higher? No. You just talk about see, basically, whatever the money, the 100 rupees that you are having now, tomorrow you think that 100 rupees will fetch you less goods, so you think the money is lower. Because you think the price of the goods will always go up. This is the assumption with which we have lived throughout this century. Possibly post-World War II, this is the assumption with which we have all lived. Basically because we are all exposed to inflation. If I say basically, now everybody is buying a mobile. We all know the cost of the mobile that you are buying today, what will be the price of the mobile? Maybe 1 week later, it will come down. But still, you buy because it has become a necessity. If your price of the good is going to fall, whether you will spend today or not, you will not spend. That is the beauty of deflation. Because we have all lived through this entire century with the basic assumption, the price of the goods always go up. The price of the equity always goes up. The price of the real estate always goes up. But need not necessarily be. This is the biggest wake-up call that has been given to the mankind in the possibly the first decade. There was a wake-up call in 2004, and possibly 2014-15, we are getting another wake-up call, where deflation is going to be the buzzword, possibly going into the next decade, possible, where the price of the goods can come down, and the price of the money, then what happens to the price of the money? If the price of the goods come down, the price of the money, what happens? It also comes down. As simple as this, the interest rate is the price of the money. So we are always used to this high price of goods, which is normally reflected in high interest rates, which we are going to see possibly the reverse of this going into this next 2 decades. So whether it is going to be good, bad, or ugly, we will try. Now, actually, since March, possibly since November of last year, what has been happening to the commodities? So basically, everybody was thinking the commodities are set for a big, big uptrend. The market was extremely long. Then what happened? Come November 2014, or possibly June 2014 onwards, there have been perceptible feeling. But of course, November 2014 onwards, when the Brent started falling, nobody in their wildest dreams imagined the Brent could come off from $100 to $45. Nobody, for that matter. What was the reason? Because everybody was thinking, okay, $100 is the some sort of a base price about which it will revolve. Absolutely, it was proved wrong. It came down to $45. From 45, actually, basically, it has been inching up, and then 67, fair enough. So, but it was a shock that was given to the oil-producing countries. And now the rest of the commodities followed suit. And then now everybody was finding a reason for this commodity decline. So normally, when the commodity decline will happen, possibly when there is no demand, there is naturally the price of the goods has to fall. That is what has happened. If the global growth is going to be lower, naturally commodity prices are going to come down. There can be 2 situations. One is high growth, rather 4 situations you can take. In any puzzle you can solve. Any puzzle about any commodity, any asset class you can solve. The economy can be in a high growth, high inflation quadrant, or high growth, low inflation quadrant, or low growth, low inflation quadrant, or low growth, high inflation quadrant. What happens to the country when it is in a high growth, high inflation quadrant? Let us ask about equities. What will happen to the equities? Equities will go up. Interest rate go up. Whether you have seen such a phenomenon in India, high growth, high inflation. Why? High growth, high inflation, high equity markets, high interest rate markets. Yes, we have seen 2004 to 2008. Dr. Reddy was raising the interest rates as well as the equities were also doing well. Real estate was doing well, extremely well, because the growth was underpinning the entire demand. Now we come to the high growth, low inflation. That is what will happen to the equity markets, what will happen to the bond markets. Both of them will be doing well. Now,